All right, so big thanks to our new sponsor this year, Pleo Tint, and their Sun Intuitive Dynamic Glass, which is innovative and intelligent glass product that can be used both commercial and residential settings. Using heat from direct sunlight, Sun Intuitive technology tints your window to automatically block heat and glare. On days of intense sunlight, when you might normally pull a shade or blind with traditional windows, Sun Intuitive glass gradually darkens, leaving your view to the outside unobstructed. Sun Intuitive Dynamic Glass allows you to be comfortable behind the glass since it blocks up to 90% of the solar energy. As less solar energy enters your home or your client's home, your AC does not have to work as hard, saving them energy and money in the process. This technology reduces interior glare while maximizing daylight and preserving your view to the outdoors. Additionally, it eliminates harmful UV rays, protecting the floor and furniture. And because Sun Intuitive Glass always incorporates laminated glass, it reduces the outside noise and offers forced entry protection, so your family, your project's family, are much safer. Easy installation makes Sun Intuitive Dynamic Glass a great choice for replacement or new construction windows. All right, so I'm very excited to be covering the introduction to the Property Assessed Clean Energy, or PACE, for residential projects, though this does cover commercial as well. We will be talking a little bit about the residential applications. This course is approved for 1 hour in continuing education units, AIA, GBCI, AIBD, Certified Green Professional, and may be applicable to your state-based or design contractor license. Today I'm your moderator. My name is Brett Little, and I am the Executive Director here at the GreenHome Institute. We're a nonprofit with a mission to empower people to make healthier and more sustainable choices in the renovation and construction of the places we live. So we're really excited because in the last few years we have been figuring out how to help people break down the barriers to the upfront costs of green building. It's always the challenge because in green building you have typically higher costs for improved energy efficiency, health, better durability, water conservation, but the long-term payback is the real value. But funding it is always the challenge, and we think Property Assessed Clean Energy is one of those tools that can break down those barriers to funding green building and even green certification programs. So this is PK Housing. It's an affordable low-income housing development up in Greenville, Michigan, Climate Zone 5. And this is one of the first affordable housing projects to use PACE in Michigan. Over $100,000 in solar, boilers, controls, low-flow plumbing were incorporated in the retrofit of this house, or of this housing development unit, with a lifetime positive energy efficiency cash flow. Another project, which is really interesting because it was PACE working with HUD, is the Phyllis Wheatley YWCA $700,000 solar and energy efficiency project. And what's unique about this is there was a lot of challenges allowing HUD and PACE to work together. And so this is one of the first projects to begin overcoming those challenges, to have these different types work together. And just announced in December 2016, this is a market rate project for 63 units, I believe, that is going to be doing different phases of PACE. 281 updated Energy Star windows, because they had windows that were single pane and didn't operate. And then they'll be getting a new roof with better insulation, stopping heat and water leakage. And then phase 3, they're looking at all these other applications: boilers, lighting, doors, laundry, and even solar PV. One unique thing about this is if you check it out online, you'll see that they strategically worked with other organizations like Michigan Saves and tax credits for existing projects in unique areas and other things. So it worked together very well with PACE to help break down those barriers to those upfront costs. So again, I'm really excited to introduce our instructor today, Elyssa Rothe, who's going to be giving us a high-level overview of PACE and how it can work for you, no matter where you are in the nation, and what you can do to help bring it about. Elyssa joined PACENation in January 2016 after working with Energize New York State's PACE program for 4 years. She has spent her career working in the clean energy sector, primarily under several marketing and outreach contracts for the New York State Energy Research and Development Authority, otherwise known as NYSERDA. She currently serves on the board of directors for 2 nonprofit organizations in Westchester County, and she has graduated from New York University with a bachelor's degree in social entrepreneurship and received a professional certification in fundraising from NYU in 2014. So with that, I'm excited to have Elyssa join us and take it away.
Thanks so much, Brett. We are thrilled to be here today talking about PACE with such an important group of stakeholders for the PACE industry. So I guess I'll just dive right in and get started with a little bit about PACENation. Looks like I'm actually missing a slide here, but I can tell you a little bit about PACENation. We are a nonprofit organization with a mission to promote property-assessed clean energy financing. And we do that by providing leadership, support, problem-solving, data, and networking opportunities for the growing universe of PACE market participants. So we receive the majority of our funding right now from grants and foundations across the country. But we also are a membership organization and will be transitioning to be more of an industry association in the next few years. So you can become a member of PACENation, and that will gain you access to our member network. And you can find that on our website, which is PACENation.us. We have lots of benefits associated with being a member of PACENation, and those include everything from monthly newsletters, quarterly market data, statistics, and updates. We're the only entity right now that aggregates data around the PACE marketplace at a national level for both commercial and residential projects. So you would gain access to quarterly market updates, as well as case studies, white papers, YouTube tutorials, and webinars, and everything that we can provide to help the industry grow. And we also are consistently sharing headlines and talking about the biggest things going on in the PACE world on all of our social media channels. So I would encourage you to follow us on Facebook and Twitter and YouTube, but our #1 go-to place is our LinkedIn group. So you can search LinkedIn for PACENation and see all of the most relevant headlines in the PACE world posted on a consistent basis. And the last little plug that I'll tell you about is our summit coming up in February. So we have the only national summit that's dedicated 100% to PACE, and that's going to be held February 13th through 15th in Denver, Colorado. And we have over 80 different sessions with, 25 different sessions with over 80 expert speakers talking specifically about PACE. And this year we have a breakout track, 1 of 4, that is dedicated just to residential PACE. And it will cover everything from the contractor's point of view, accountant treating, how solar interacts with PACE, and how to scale the energy efficiency market through PACE. So we would really encourage you to sign up and join us and meet the biggest players in the industry and learn all about property-assessed clean energy. So now I'll get started. I'll let you know that today I'm going to be giving a broad overview of how PACE works, but I'm more than happy to answer any questions you have and talk a little more specifically if that's what this audience would like to do. So definitely send in any questions that you have at all, and we'll go through everything for you. So at its root, PACE is a tax assessment-based financing mechanism. And that means that rather than paying back a loan through a bank or through a typical lending institution, you would repay your property-assessed clean energy financing through a tax assessment that's placed on your regular tax bill. PACE can be used for energy efficiency, renewable energy, and water conservation projects by definition. So now I'm going to break through exactly how this process works in the next 2 slides. So there are legislative requirements associated with PACE, because this utilizes the tax assessment structure. So back in the early 1800s, late 1700s, when taxes in this country were developed, the tax assessment structure was put in place. And that was created for tax assessment districts that fulfill a public purpose. So that's why you can have a line item added to your property taxes to pay as a group for sewers, or to pay for parks, or to pay for sidewalks. PACE works in exactly the same way by the government stating that PACE fulfills a public purpose and can be added to property taxes to repay an energy efficiency project or clean energy project. So that first step is for the state level, to pass legislation that establishes PACE fulfills the public purpose and can be applied to the tax structure. And that legislation also gives local government entities the authority to establish the PACE program itself. And once that legislation is passed, the second step is for local municipalities to pass local ordinances to opt in to the state legislation and enable PACE programs. So with that being said, there are lots of different models that have been put in place for PACE financing. They don't all include municipal ordinances to opt in based on if it's a state level program, but this is the general framework that we see implemented across our country. So here is the step-by-step breakdown. So as we already talked about, you enable the statewide legislation, and then the sponsoring local governments, who are the taxing jurisdictions, opt in to use the program and to actually add those tax assessments to the local bills for PACE. So an energy project and the construction would proceed exactly as it typically would. Nothing about the project process changes. PACE is just the financing mechanism that comes in at the end to finance a project. So you can still use any incentives, any tax credits, any grants or monies that you can find to create a capital stack and bring down the cost of the project, and then PACE comes in at the end to finance. And then rather than the homeowner going to a typical bank to get that funding, it's provided by a specialized PACE lender or by a bond that's issued by the local government implementing the program. The PACE lender provides the funding to the contractor to pay for the project, just as any other loan would, and then directs the local government to add that tax assessment to the property's regular tax bill. And most assessments are amortized over the term of up to 20 years. We see this most typically at 15, but it's paid in regular annual installments for the duration of the assessment, and then it disappears. So one of the benefits is that the PACE repayment, since it's collected with the regular taxes, there's no additional paperwork, there's no additional entities for the government, the lender, or the property owner to deal with. And then the local government collects those taxes, separates out the PACE portion of the taxes, and then remits it back to the original lender. So just to show this in a little different lens, but basically the same information, there's 4 entities that are involved in every single PACE project. And that's the government, who is also the local government, who also is administrating the PACE program, the source of capital, the contractor, solar installer, or energy service professional, and then the property owner. So the administrator or the local government would approve the project, would handle all the applications and fees, and sign off on moving forward. The PACE lender would come in to provide the capital to the energy service professional, who would complete the project, and the government would instruct the lender would instruct the government or the administrator to add that property tax line item to the regular taxes. The property owner would repay that on their regular bills, and then the municipality would remit the PACE portion back to the financier. I'm just going to double check and see if we have any questions so far. Okay.
Yeah, so there was a question, and maybe you're going to get to it, but what happens when the property is sold? Does the PACE payback follow the property?
Yeah, it absolutely does. And I will talk a little bit more about that as we move forward, but that is one of the biggest benefits of PACE. It is attached to the property and not to an individual or the owner. So whoever holds the deed to that property holds the PACE program, holds the PACE assessment. And while they'll see that extra fee or the extra assessment on their tax bill, they'll also inherit the energy savings from the project. So net-net, we usually don't see an increase in costs, and as long as that is explained to the property owner in a way that they can understand, we haven't seen it be a barrier to selling. And I can talk more about that in detail in a little bit. So there are lots of different things you can finance using PACE. The state legislation will usually define exactly what you can do, but in general, it's anything that reduces the energy consumption of a building or enables the use of renewable energy. And there are also some areas that allow water conservation measures as well. And PACE can be used on any existing property. We're seeing actually that it's now expanding into new construction as well. I know today we're primarily going to be talking about residential for sure, but as long as a property is not owned by the municipality, then it can use PACE in most cases. So I'm going to talk about some of the biggest benefits of PACE right now and why this is such an attractive option, and then we can go through some more questions you have before I go to the next section. So the two biggest benefits of PACE is that it can cover 100% of a project's hard and soft costs. So that means application fees and any fees that are imposed by the municipality or the administrator, and if there's an energy audit required, and if there's any asbestos remediation before the project can start, anything involved with this project can be rolled into the PACE funding, and that's included in the legislation of most bills. So that means the property owner does not need to have any money down, and they don't have to have a reserve to cover, you know, an initial 15% or so, because they can only find 85% from typical loans. The PACE lender will cover 100% of a project's costs, and they don't have to have anything out of pocket to get started. And the other big thing is that we can finance PACE for up to 20 years. So that allows, with a combination of low interest rates and long terms, the ability to see a positive cash flow, because you're able to stretch those payments out to the point where the payments itself are lower than the amount being saved on energy bills for the most part. So that is what we call positive cash flow, and that means the property owner doesn't see any money coming out of pocket in the beginning or for the duration of the project. One of the things that Brett was talking about in the beginning was one of the case studies he showed with a multifamily property is that positive cash flow for the duration of the project. And that's important because over the lifetime of the payments, the project is usually breaking even or cash flow positive. But after those payments are done being made, the property owners are just saving on their energy bills, and they're not having to pay anything. And then, of course, the assessment stays with the property and automatically transfers to the new owner in the case of a sale. It doesn't have to transfer. If need be, the property owner can choose to pay it off, and we can get into more detail later on if you'd like about subordination and whether the assessment is a senior lien or subordinated lien and contractual subordination and all the details around that. But the most important thing to know is the property owner has the choice to pay it off or to transfer it to the new owner. And again, that new owner would inherit the payment as well as the energy savings from the project. And then one of the most important things about PACE is that the amount that can be financed is determined by a home's equity. and not by an individual's credit score or any other credit aspects. So while those eligibility requirements vary between different PACE programs, there are very specific guidelines that have to be adhered to. The homeowner has to be current on their property taxes. They have to be free from bankruptcies, typically for the last 7 years. And they have to be current on property taxes with no judgments or liens or involuntary liens for the last 3 years, as well as the mortgage-related debt. So any debt on the property or any mortgage the property has cannot exceed 90% of the home's existing value. So while we're not looking at a credit score because we're looking at the property's ability to carry this tax charge, we are looking very closely and scrutinizing the ability for this property owner to make those payments. So I'll pause for just a minute and look through and see if we have any questions I can answer. Okay, there's a question about legislation. That's a great question I'd be happy to talk about. What is the barrier to legislative adoption of residential PACE? So you're right that there is a legislative barrier to residential PACE. I'll say that right away. Commercial and residential PACE are two very different products. And although the basics of how they're implemented in a real-time practice are similar, the variables and the parties involved with residential and commercial projects are very different. So we have seen commercial legislation pass much more easily than we've seen residential PACE pass, and that is primarily because of bankers associations. The bankers associations and the mortgage lending community have started to pose opposition to PACE. And we've seen their argument transform throughout time, and they have come up with different reasons to oppose PACE. For the most part, it's pretty transparent that their opposition is rooted in the fact that this is a competitive product to typical mortgages. And the bankers are thinking that they don't want their mortgages to be primed by PACE. So PACE would take a first lien status over any existing mortgage because it's part of the tax payments. So if there was a case of a bankruptcy or if a delinquency were to lead to a bankruptcy and that property was foreclosed upon, the PACE lender would be made whole for any missing or delinquent payments before that mortgage lender would be made whole. And that is just inherently how tax assessment works. That's why this type of financing is so secure, and these lenders are able to offer such low interest rates because it's very, it's rooted in the tax structure, and they're going to get their payments for the most part. And this is scary to the mortgage lending industry because they don't want to be put at risk. So they've posed lots of different arguments, and as each of them are shot down or disproved by their industry, their arguments have kind of morphed and transitioned. So while at first they were rooted in a competitive base to the mortgage lending industry, they didn't want the value of homes to decrease. They didn't want to lose money. Now that that argument has been disproved, they're transitioning to pose opposition under the pretense of consumer protections. So now they're saying that this is a product that can take advantage of the low-income community, and we want to make sure there's disclosures, et cetera. And I'm going to talk more about that later. I'll just say right now that PACE has some of the strongest and most stringent consumer protections in the lending industry right now. But the mortgage bankers have a lot of power and they have a lot of influence. And when they come out in droves to oppose this legislation, they tend to be very effective. So again, we haven't seen that type of issue with commercial. For the most part, commercial projects do require lender consent, which hasn't been an issue because on a commercial property, we're much more likely to see payments made. But I'm going to get back to this in more detail.
Elyssa,
yes.
Will you be planning on talking about when a state approves PACE, then it falls into the county's lap to, take it up and really implement it. Will you be discussing that form of opposition as well, or would that be a good time to talk about that too?
I'm not sure what you're actually talking about with opposition. Maybe you can
Yeah.
let me know something.
So maybe I can give you all a little bit of personal experience. So to be clear too, when we say commercial PACE, we are referencing multifamily mixed-use mid-rise buildings or even high-rise buildings that are residential in nature but permitted as commercial. And so here in Michigan,
the way to think about it is the ownership structure. So it's, no matter who's housing in it or what situation it's being used for, if it's commercially owned, it falls under commercial projects, even though residential homeowners are living in it.
Right. Yep. So we do in Michigan, we don't have any residential PACE by definition for single family, but we do have the opportunity, as you saw earlier, to impact residential use units. And so in some specific counties here in Michigan, the peer opposition has been at the county level and even to some degree the city level. And the real fear there is that there is a belief that there will be a large amount of administrative tasks and duties added to the government offices of these counties that would otherwise cost the taxpayers more money. Now, whether that's true or not, is the argument, but that is one of the barriers we've seen to the multifamily projects we're trying to get going here in some counties in Michigan.
Yeah, so that's definitely a question and a fear that comes up and has been disproved over and over again. So it depends on the type of software that the municipalities are using to implement their tax structures. It depends on their budgets, and it depends on how many people they have in that office. But if we're going to be realistic about PACE and think about how many projects can actually get done in a year, and how many houses are already on the tax rolls, this argument just doesn't line up. So they're using a tax assessment software or to collect the tax rolls and implement their tax structure. And it could be expensive, it could cost nothing depending on the software they're using to be able to add a line item assessment. But have you ever heard that the government is not going to implement sewers or not going to implement sidewalks because it's going to cost the taxpayers too much of an administrative burden internally, not the cost of the project, but an administrative burden? No, because it doesn't make sense. If we've got thousands and thousands of homes on the tax rolls, and we're going to be adding maybe per municipality 25, 50, at the most 200 line items to those tax rolls, that's not a significant burden in comparison with the work that's already being done. And if there truly is apprehension about that, the municipality always has the ability to add a fee to the PACE project to cover that cost. We discourage that because we want the PACE product to remain competitive in the marketplace with the lowest possible administrative fees and interest rates. But if there really is true apprehension and concern about that, they could always add a fee. Does that answer your question, Brett?
Yeah. I mean, mine was more of a comment / question, so thank you. And I do see some follow-up conversation coming up with that, but maybe you want to move forward and we can circle back to some of that.
Okay, there's two things I'll answer really quickly. One question says, can the government be the source of capital, aka the lender? And the answer to that is yes, as long as the legislation permits it. So PACENation advocates for the government to access as many sources of capital as possible for PACE projects. And that includes issuing municipal bonds and accessing internal funds if possible, as well as inviting external lenders and independent sources of capital. There are certain states that have said they do not want to allow the government to issue bonds to fund PACE projects, and they only want to use independent lenders. So you'd have to check the legislation, or you can contact PACENation and ask us if you have a specific question. But the general answer to that is yes, the government can be a source of capital.
And if I can interject real quick too, we had a particular city here in Michigan that did attempt bonds, and it failed, and it has left a bad taste in the mouth of trying to get it approved further.
The next question is, I'm assuming it must be disclosed when it's in the market, and the answer to that is absolutely yes. When you would pull the taxes to see what the taxes look like for the property, it would show up right there along with any other assessments, and that would be the realtor's responsibility to explain that to the homeowner and educate them on why this is an asset to that property. And we are working with lots of different realtor groups to make sure that message is understood and disseminated properly. Okay, so I'm going to move on now to give just a general landscape of where PACE is today and what the country looks like in terms of programs and legislation. So this map shows a few different things. It shows where PACE has been enabled, which means that legislation has been passed, where there's a program in the process of launching or being developed, where we have launched programs that haven't made their way to closing a project yet, and where we have active programs with funded projects. So this map shows both commercial and residential projects, and you can see that we've got 32 states plus DC, so 33, that have PACE-eligible legislation passed, and there are 19 states plus DC that have active programs. Now, when we go and look at just the residential map, it looks very different. We only have residential programs right now in California, Florida, and Missouri. And I'm going to explain the reasoning behind this now, which has a little bit of history. So I don't want to get too into the weeds. I'm going to gloss over some of the specifics, but if you do have questions, I'm more than happy to go as deep as you'd like. So PACE was developed, the whole concept of PACE was invented in 2008, and it was invented for residential properties. And states started passing legislation all over the country, getting, sorry, my mouse isn't working properly, getting PACE legislation passed all over the place. And in 2010, the FHFA, which is the Federal Housing Finance Agency, they're the federal regulator of Fannie Mae and Freddie Mac, issued a statement that they would cease purchasing mortgages on PACE-encumbered properties. And that really shook up the marketplace and scared both lenders, administrators, and local governments from using residential PACE. So the focus switched over to saying, how can we implement PACE in the commercial landscape? And we started seeing more commercial legislation pass and commercial programs take off. So until about 2013, it was primarily a commercial PACE market getting started in the country. And at that time, California decided they were going to launch residential PACE regardless of what the FHFA guidance said. And Governor Jerry Brown implemented several different marketing strategies to show his support for PACE, and 2 different programs launched. One was called Renovate America under the HERO program, one was called Renew Financial, and that encouraged many other smaller programs to launch as well. So we'll just flip back and show you. Right now there's 1, 2, 3, 4, 5, 6, 7, 8, 9 different residential programs in California. And they were wildly successful in the residential PACE market because they were willing to take that risk and use private lenders to undergo financing. They also implemented a reserve that is funded with $15 million and is in place to make any mortgage lender whole if they do encounter a loss due to a PACE project bankruptcy. And that that fund has never been drawn upon. There has never been a significant enough loss to initiate the use of that fund, but it is in place as a safeguard. So now we're in 2013, and between 2013 and about the beginning of 2016, there was an enormous amount of projects done in California, about 2 billion projects, $2 billion worth of projects were completed in California. And that allowed studies to be completed and enough analysis in the market to see if this really was a risky product and how it was affecting the mortgage lending industry. And in 2016, the Federal Housing Administration, who set standards for underwriting and home building for private lenders, put out a statement saying that they support PACE, that it increases the value of homes, that it decreases the instances of foreclosure and bankruptcies, and that in general, this is a product that the marketplace benefits from. So this has caused somewhat of a resurgence in the residential PACE world and has encouraged states that were holding back on launching their residential programs to think about doing so, and has also encouraged states to introduce residential legislation. Now, since this time when the FHA released their guidance, PACENation, where I work, the National Industry Association for PACE, has released consumer protection standards to make sure that all of the appropriate disclosures and protections are provided for customers by instilling standardizations and guidelines for administrators. The Department of Energy has released best practices for our PACE in coordination with PACENation and some of the biggest lenders in the residential market. And just this week, HUD released guidelines as well. So the federal environment is starting to really embrace PACE as a viable and tangible way to improve the housing market, with the contingency that there are appropriate standardizations and protections for consumers, which we could not support anymore. So I hope that wasn't too confusing and gives kind of a clear outline of why the residential market was stunted for a few years. But here are some stats to show how far we've come. So even though CPACE has been implemented and active for much more locally and geographically all across the country for longer, we've seen $332 million completed in commercial PACE projects. And we've seen over $3 billion worth of projects completed in the RPACE side. So RPACE has been wildly successful, even though it was confined to California, and in the past 6 months has slowly began to expand to Florida as well as Missouri. And here is a snapshot of the cumulative financing in the RPACE world thus far. So we really, halted in 2013, 2010, everything stopped. And then in 2013, California decided to launch this program regardless of the federal guidance, and it just completely took off. And you'll see it just absolutely continues to grow exponentially every month. And these are the type of improvements we're seeing in the RPACE world. So energy efficiency right now is the leader in PACE residential upgrades, with renewable energy trailing right behind and water conservation measures bringing up the rear. But we do expect to see renewable energy projects catch up in the next few months to years. We've seen lots of partnerships between PACE administrators and solar providers and installers and developers. And the solar industry as a whole, CEUS has made the statement that PACE is one of the best ways to grow the solar industry, and has made a concentrated effort to work with PACE providers and PACENation to really ramp up solar. So we're excited to see what the next few months hold there. I have just 2 slides left, so I'm going to cover them quickly and then more than happy to talk about any questions that you have. So PACENation provides as much information as we possibly can to the public, and if there's something you'd like to see that we don't have, please let us know so we can be as useful as possible. On our website, pacenation.us, you can click on that map that I showed you in the previous slides, and you'll be able to check out every single state. So each state has their own page, which shows all of the active programs. Here you can see the HERO program is selected, but there's lots of other programs that exist. And it also shows all of the legislation that's active in that area, what the different bills that have been passed to make the program possible, as well as every single municipality that has opted in or is financing projects right now. So you can sort this by county, by municipality, or by program name to find the best option, and we have that available for every single state. And again, I just want to plug our summit one more time and encourage you to come and learn a little bit more about the industry and the biggest players, as well as join PACENation as a member if you're able to do that. So here's my contact information. Please feel free to reach out to me at any time with any questions you have about PACE in general, and I can talk you through any projects you're thinking about or any questions you have in general. So, Brett, do you want me to go through some of the questions, or do you want to direct them to me?
Yeah, thanks, Elyssa. We've got a couple of questions pouring in. Everybody, we've definitely got quite a bit of time here for more questions, so please get them in there. And before we get to the questions, the CEU reporting, again, at the end of this session, you'll get the survey. Please take that. GBCI is all self-reporting. AIA, you'll get us your number. And then for those of you listening to the on-demand, you will need to complete a 10-question quiz with a passing rate. So that's just those of you listening to the recorded session. And again, a huge thanks to our members, our sponsors, Suntuitive, Niagara, Build Equinox of the CRV, and Panasonic, as well as our board of directors, all of our volunteers and presenters. We could certainly not do it without you. So there was one question that kind of came in from Patrick here, Elyssa, that gets into some of the minutia of determining where the PACE project kicks in at, if you will, as far as the baseline efficiency of the building. So the specific question is, can this be used on new construction or gut rehabs of abandoned buildings that don't have baseline energy use? And I actually have a specific situation in this case that I can share, but just from a broad strategy, Elyssa, maybe you can tell us a little bit more about how they would approach that.
Yeah, so we've seen new construction start to develop on the commercial PACE world. We haven't seen any yet on the residential side, but that doesn't mean that it can't happen in the future. There are definitely techniques for establishing a baseline energy usage calculation even in abandoned buildings by looking at what the, based on when the property was built and the systems that would have been in place, estimating what that energy usage baseline would look like compared to updated systems and Energy Star rated equipment that's put in now. So some areas will allow that to be done, but it really depends on the local program and what they're comfortable funding, and if the legislation specifically allows or disallows new construction. So as long as the legislation doesn't specifically say that new construction cannot be done, for the most part it can be, as long as the program administrating the project is comfortable doing it.
Yeah, so a project team we were working with, Patrick, in this regards, did secure a historic, very, very old building that hasn't been used for 10 years. And obviously it's, nearly impossible to get an energy baseline of something like that because there's just no history in the last 10 years, and there's windows missing and leaks in the building. And so essentially it's almost by definition a massive gut rehab, or even by permit a new construction project as far as code goes. Add to that, it's looking at using low-income housing tax credits, and depending on how many points you want in those tax credits, you have to set your project at a certain level, let's say in this case, LEED Silver, which then brings you, for a building like that, I believe somewhere around ASHRAE 2010, 2010, 10% above that. So as you can imagine, we're sitting here scratching our heads. Where do we start the PACE project? Where does the funding actually kick in? Is it from a building that's sitting there in terrible shape, or does the PACE funding kick in at the Michigan code, or does it kick in at the LEED Silver level? And so that's actually a question we still haven't answered, and that we've been exploring with our local PACE operators, and it happened to be in Michigan, the LEED Green Michigan team. But it has been a fun exercise, if you will. So a comment from David: our state has passed PACE legislation, but none of the local municipalities have adopted it. What resources are available to local municipality administrators to support them to bring it to their city, county councils?
That's a great question. So the first question to ask, though, is why none of the municipalities have done that. So if there needs to be a few things in place to launch a successful program. The first is adequate funding for the municipality to administer a program, or successfully vet applications and create a process to make PACE feasible in a cost-effective way and scale it. So if that is a barrier, sometimes what is done is outsourcing the program to a third-party administrator or an entity that exists just to administer PACE projects. And there's lots of those operating throughout the country. But the other reason a municipality might be hesitant to start a program is because the state legislation that has been passed isn't good. So there are lots of examples, unfortunately, of PACE laws that have been passed that need to be amended in several ways to instill enough confidence in the local governments that this program is workable. So we have on our website a legislation page where you can see every single PACE bill that has been passed to date, and you'll be able to see in reading it, pretty easily, I think, if there needs to be some amendments to that. And you can contact us and we can let you know if there's any initiatives or efforts underway right now to amend legislation that hasn't been successful in getting a program off the ground to date. That all being said, if the legislation is workable and doable and the municipalities just haven't gotten started due to a lack of interest or a lack of initiative, we do have some resources to help with that. You can check out on our website our one-pagers by looking at our document library. And we have a guide for municipal leaders to talk to their local governments and to talk to their stakeholders in the best ways to start a PACE program. So that offers advice and guidance for all different types of members of the community and how to talk to their municipal leaders to launch a program, and how those municipal leaders can take steps to start a successful PACE program. And of course, we're here to help out with any steps along the way.
So this is a pretty short question. PACE is based off of assessed tax value, 90% of it?
It varies depending on the program's guidelines. There are some states that actually define what that LTV needs to be, but for the most part, it's determined by each program. So generally, we've seen that it usually falls around the 90% range, but you would have to check with the specific programs to make sure.
Getting back into some energy modeling questions. Would residential PACE for new construction use the HERS rating? So for those of you who don't know, that is the EPA's Residential Energy Network's HERS Index Home Energy Rating System, which I believe is being used on a third of all new homes in this country. Would that be used for modeling the design plan versus the average home or code home, I would say, rating, and determine the financing before construction? And I'll add to that, you know, would it have to be HERS, or are there other programs that can be used? Or Elyssa, maybe you can say that's, of course, contingent on what's approved at the locality.
Right. Again, it's all hypothetical right now, so it hasn't been done. There have not been new construction projects on the residential side. On the commercial side, which does include some multifamily projects, there have been new construction, but again, the HERS rating wouldn't apply to that because it's under the commercial jurisdiction.
What about for gut rehabs? Are people using HERS then for the existing homes to get the financing?
I think a gut rehab, I'm kind of lumping that in with new construction, gut rehab, major renovations. We've only seen our PACE be used for existing buildings and existing homes right now. Again, there's no reason at this point why it couldn't be done, other than it's not something that the administrators are implementing right now. But I'm sure you can talk with them or work with the local programs to, you know, try and get that going if you have a very feasible project. I mean, PACE is a new industry. Like I said, we just got started in 2008 in the invention of PACE, and it hasn't taken off until about 2014. So we're still working our way through all these different ideas and creative concepts around making PACE work the best that it can. So I think all of the different market players involved always welcome new ideas and creative solutions to how we can implement PACE even better and in a wider capacity.
And just to reiterate, because we have a couple like very specific questions coming in, but just at a broad view again, the states that have approved PACE commercial can only be used for commercial code projects, and the states that have approved PACE residential, that residential is being used for residential code projects. So really, if someone has a specific project in mind, and it might fall within like that realm of uncertainty as to what it's comes under the code, they would first want to determine what the code, what the permit needs to be pulled under what code before they determine the financing. Would that be, and maybe you can say it better, but would that be accurate?
Yeah, I mean, I think the first step would be to contact the program in that state. So I see there's a question right now about Colorado. So Colorado is planning to launch a residential program in the next 6 to 12 months. So I think the first step would to contact them and ask them what their launch plans are and how their residential program is going to work, what their requirements are, and if they've determined eligibility guidelines for specific measures. And then once they have those in place, then I think what you said, Brett, would come into play.
Great. I have heard of projects in areas that, you know, could get either incentives or fines for not mitigating stormwater or certain percentages of stormwater. Is there opportunity for PACE to also fund the mitigation of stormwater when there is financial savings to be had?
Again, it depends on the local legislation. So sometimes if you're using stormwater in a constructive way and mitigating stormwater waste, then that can count as water conservation, depending on how it's being used. It depends on the guidelines of the specific program and if the legislation allows for water conservation measures.
And here's a comment that I'll share, and then it kind of gets into another question that we get. And so this is Lee just mentioning here that Energy Star Portfolio Manager can also be utilized for baseline and improvements efficiency in lieu of the HERS score. So thanks for interjecting that. And you know, obviously, I believe Energy Star Portfolio Manager can be used down to 20 unit projects for multifamily housing. But at a larger rate, you know, taking a step back, are you seeing PACE being used both in single family or multifamily, to also fund green certification, LEED, Enterprise Green Communities, National Green Building Standard, Energy Star certification. And the reason I say that is because, do you see lenders getting more of that quality assurance or guarantee, if it goes through those programs, that they're actually going to get their money back because there has been a third-party verifier ensuring what was actually implemented was done right?
So we're working with the U.S. Green Building Council right now. They administer the LEED program, and we're working with them to kind of cross-reference our resources to see how many of our commercial projects and how many residential projects actually use both PACE and LEED. We're in the process of doing that, so I can give you a more specific answer later on. But the general answer is that with a LEED building or with a LEED home, all of the measures aren't specifically related to energy efficiency or renewable energy. They really cross the gamut of sustainability. So PACE can be a portion of that capital stack in funding a LEED project, but there usually is the need or the necessity for another type of financing, grant, or incentive to come in and pay for the portion of a project that isn't directly related to energy.
Great. Well, Elyssa, I really appreciate. If you don't mind,
Brett, if it's okay with you, I'd like to answer just one more question that came in about lender consent. Does that feel right?
Yeah, please do.
Okay, great. So Lee, I saw you making a few comments about lender consent, and there's definitely lots of different feelings about that in the industry, but I just want to address some overarching principles that sometimes are misunderstood. So with PACE taking a senior lien status and coming before a mortgage holder, in the commercial world that requires, for the most part, lenders, the existing mortgage holders, to give lender consent before a PACE project can start. That's not required in the residential world because many mortgages that are given by Freddie and Fannie have been bundled and securitized and just aren't even traceable anymore. But if they are refinancing a property, or if a homeowner is selling a property to an owner that will be getting a mortgage from a secondary lender, then we'll be able to speak directly with that lender and talk about lender consent. So although it seems counterintuitive for a mortgage holder to want to give lender consent to a PACE project, there are three big reasons why we're seeing it over and over again. So I'm just going to talk about those really quickly. And the first is that although there is an additional fee on the property taxes, like I've said a few times before, the overall utility bills of that property are going to decrease. And net-net, in almost all cases, that property owner is actually cash flow positive. So that enhances their ability to pay their existing debts and to pay their mortgages. So that's an incentive for a mortgage holder to give a lender consent. And then doing a PACE project increases the value of the property. So that mortgage holder's collateral now has an increased value without them having to do a single thing. So that's another reason to encourage lender consent and why we've seen lender consent pass so easily. And then, of course, that property owner always has the option to refinance if their existing mortgage holder is really staunch in not wanting to approve PACE. There's nothing stopping that property owner from going to one of the hundreds of banks, national level banks, big box banks, as well as local and regional banks that have made it their policy to approve PACE projects because they see them being good for the overall value of those projects. And I'll just also say one word about subordination and senior lien. In California, the liens are all senior, but they have implemented something called contractual subordination in some of their programs. And that means if the existing property owner has a PACE loan and they want to sell their property to a new owner who is going to be getting a mortgage from their own bank, and the mortgage owner doesn't want to take on that senior PACE loan, the existing PACE lender contractually subordinates. So while on the tax rolls it is still senior to the mortgage lender, they create a contract that says, in the case of a delinquency, in the case of a foreclosure, we subordinate, we will not claim our portion to make ourselves whole before the mortgage lender. And that has been enough to appease the majority of mortgage lenders. So that's been a great solution that we've seen in the market. And then I guess I'll just, for good measure, add in that, again, overall, the bankruptcy and delinquency rate among projects with PACE actually is lower than the standard rate for bankruptcies and foreclosures on properties. So PACE in general is good for homes and is utilized for the most part by the more responsible property owners that tend to understand financing mechanisms and pay their taxes in general.
That's a great way to end it, Elyssa. Well, that's all the time we have as far as questions go. And so I thank you for your time, and I thank PACENation for allowing you to do this. Elyssa, real quick before we wrap up, where can people go to find out more information if they want to learn more or get involved locally where they are?
You can visit our website, PACENation.us, and under the Resources tab, you can find anything you've ever wanted to know about PACE. And again, if it's not there, if you can't find something you're looking for, let us know, and we're happy to develop it and make it available to the market.
Very good. Well, thank you for your time, Elyssa. Thank you, everybody. Have a great rest of the week, and take care.
Thanks, Brett.